Hello, everyone. Thank you for joining us today. I'm Vignesh, and I'm an influencer marketing specialist for FYERS, a company dedicated to empowering new age traders and investors. Today's topic is regular income from covered call strategy. How many of y'all know what covered call strategy is? Please type Y or N as in yes or no in the comments. Let's see some hands. How many of y'all actually know what a covered call strategy is? Oh, that's a lot of responses. I see a lot of yeses and nos as well. Okay, perfect. So let me tell you what a covered call strategy is. Covered call strategy involves selling call options on stocks that you already own in order to earn additional income from your existing portfolio. By the end of this webinar, you will have a solid understanding of how the covered call strategy works and how to implement it in your own investment strategy. Today's webinar is hosted by Mr. Santosh Pasi, a SEBI-registered research analyst who is the founder of Pasi Technologies and the co-founder of Sonic Alpha. He is an options trader with an overall experience of 15 years with qualifications including CISA, PMP, MBA, and MCA. Welcome to the webinar, Santoshi.
Thank you, Vignesh, for giving me the opportunity, and thank you, FYERS, for taking this initiative so that a lot of the trading community will get benefit of the same.
Santoshi, your camera seems to be off.
Okay, let me switch on the camera. I hope you are able to see me now. Give me confirmation. Are you able to see me?
I think your camera turned on, but I still see a blank screen.
Okay, awesome. Let me see. I think now you should be able to get it. And switch on once again.
Yes, now I can see you.
Yeah,
Yes,
thank
there you are. It's always a delight to interact with you, Percy Ji.
Same here, Vignesh. I've met you many times, and FYERS they have a hug. Put in a hug me a fire.
I'm
So you
so
see,
glad to have us with you here today.
same here.
We've had a huge number of registrations from this webinar, and
Mhm.
I'm confident that this topic will help the viewers with their trading journey. So, Santosh ji, I recently came across an interesting article published about you,
Mhm.
and I must say it was very inspiring journey of yours. I don't know how many of our viewers have read the article, but let's talk about your journey for a little bit before we jump into the main topic, you see. So, can you tell us how you first got interested in options trading and what led you to pursue it full time?
Vignesh, thank you so much just to go through those articles. Okay, it was recently published around, if I'm correct, last Sunday. Uh,
Mhm.
and yeah, journey started. I mean, a lot of my colleagues, although I'm from the tech background, so I was not too much into the options or maybe into the share market. I would rather say a lot of my colleagues they were already into the share market, and as written in the article, because of ESOP that was signed to me, and I was supposed to exercise that because of some taxation issue. And then I thought, yeah, there's a big scope into that. I thought let's jump into the share market. So initially, as a lot of guys, they do a normal cash trading, those kind of things I've started. And gradually I've moved towards the options trading. And I see that there is a lot of opportunity to learn and take it forward. So that was, I've generated my keen interest was trading. Okay. So basically, I'm from the security, that is cyber security and the financial security. So a lot of guys ask me, Santosh, what do you do? I said, I'm into security and securities. Okay. So it's been almost now more than around 17 years, and I'm been into the trading world, and the market is a kind of, I mean, enough and blessed me to move forward. Yeah.
Lovely. That's there's so many things I'm sure I can learn from you. So for people who don't know, I had met with Santosh ji last month, last year, last month, in one of the events, and there's so much that you could learn from him just by interacting with him just for a few minutes. So, he's a great. Person as a he has a lot of knowledge to share, and definitely something, if anyone has a chance to interact with him, I would definitely encourage you all to talk to him and gain his insights on various topics as well. So Santoshji, what were some of the challenges you faced during your journey to becoming, like a full-time options trader?
Yeah. As Vignesh, if you see the share market, we have a lot of professionals are there. Okay, so once you start as a novice, so you are actually competing directly with those professionals. So definitely there is a lot of challenge. It's not an easy thing that just to jump into the market and move forward. So for me, the best, I mean, other things like as a lot of the new guys would do, I was focusing more on the profit rather than the risks management. Okay, so that was the most important thing. So gradually, I would learn the lesson that yes, the most important thing is to manage your exposure, manage your risk, and that is what took me forward. In fact, initially when I was trading cash market, basically I was more looking towards something going drastically up or going drastically down, those kind of things. But slowly, because of this a lot of losses, I've learned that yes, I have to manage my risk, and the best instrument to manage is to add the options into trading. Hence, I've moved into the options world, and day in day out, we took a lot of different strategies. We have made our own custom strategies.
Mhm.
And whenever you're trading options, the most important thing you have to understand the underlying asset also, because, for example, the underlying asset of Nifty would behave differently from the bank Nifty than with the you need to understand the nature of the underlying asset. And if you're trading the stocks, then it would be completely different ballgame with the stock options I'm talking about. So you have to understand what is you're trading, whether that is a volatile underlying or maybe a kind of a less volatile underlying. For example, like I normally trade the bank nifty. I'm used to a bank nifty, but whenever I try to do the same trade in a nifty, most often that doesn't work. Okay, so you have to understand what you are trading, and then based on that you have to make your own strategies. And the most important thing I would say is a risk management. For example, whenever I'm trading, I make sure that whatever
Mhm.
number things are shorted, the same amount of the things are long. Okay, that is like insurance. So assume that I was shorted 10 lots of ATM put, then I'm gonna have a 10 lots of OTM call long. So that always there is a hedge, there is an insurance in my positions, and that makes life much easier because I know there may be some surprises, but it won't bankrupt me. I would have losses which would be acceptable to me.
That is very inspiring. Can you share with us some of the key takeaways from your journey that would be helpful for anyone interested in pursuing options trading as a full-time career?
First of all, you need to learn continuously. Okay, it's not that you just learn and you become like we have seen that movies. May there's a dialogue called "Hami Bhagwan." Okay, so that doesn't happen. So you have to keep on learning. Okay, first of all thing, and then we know that regulators they keep on adding a new regulations because of the new dynamics in the market and those to protect the retailers. So we should be aware of that and. Most important thing is, as I told you, risk management for me is most important, and then keep an eye on like lot size changes, your margin rules changes, those kind of thing. In fact, like last time when I met with your CEO, founder, and I've asked him to make a like verified MTM. I was keen enough to accept the request, and hopefully that will be thing. So, like you guys are keep on adding some new features in your tool. Same way, all the traders they need to keep on adding new things. In fact, like in one of algos. Okay, so it's been almost like 2 years now, and recently, like we have changed the way the algo used to trade earlier because the market keeps on changing. So few strategies that you're using as of now, it might have some kind of a shelf life. You have to understand that. Okay, it may survive for years, 5 years, 10 years. For example, like initially when you started using mobile, so 2G or 3G were there. There was some kind of a shelf life for those kind of phone, or maybe earlier phones. Okay, and set I'm talking about. So those were the old phones, and those were like were a shelf life for 2 years, 3 years, and then gradually Android came into the picture. It took it forward. So same way, if you're trading the options or maybe anything in the market, just keep on learning and adapt the changes. If you adapt the changes, then you're going to move forward. If you resist the change, then that will be difficult. And that is the only reason, if I say, we have adapted algo trading, which fire support algo APIs.
Thank you very much, Santoshi. So, viewers, just to give you a little context of what Santoshi was talking about, So in one of the conferences that we had met last month, both Santoshji and my team as well. So he had brought up a point during a Q&A session with Tejas Kode, who's the CEO of FYERS. The question was that right now traders are reliant on third-party providers to create this verified PNL. So why can't a broker introduced this feature? So this was spontaneously, at the stage, Santoshi asked this question, and then we committed to creating this feature. And Santoshi, I wanted to give you an update. The feature is almost ready. We are making sure that it is completely secure, before we release this feature. So it's right now the beta testing phase. You can expect an update from us very soon, and you'll be the first person to know, because if it wasn't for your question, we would not have implemented this brand new feature into our platform. So as soon as it's ready, you'll be getting a personal call from me, and I will let you know how soon we'll be going live on this.
Thank you, Vinesh. Thank you so much. I was I was sure at that time itself that yes, it would be there very soon.
Thank you so much, Santoshi. So let's. I think it's time we should proceed with our main topic. So viewers, at the end of the webinar, we will have a Q&A session where you can type your questions in the Zoom Q&A option. And if you're watching this video on YouTube, then please use the live chat feature to ask your question. This webinar will also be available on YouTube for, in case if you want to watch it again later, you can go back on the FYERS YouTube page and watch this webinar once again. So Santoshi, over to you. Let's get started.
Thank you, Vignesh. And let me share my screen. Once you see my screen, just confirm that it's easy for me to move forward. Okay. I hope you are able to see my screen.
Yes, I can see your screen now.
Okay. So all the participants, good evening. And if you're another part of the geo, so hello, good afternoon, good morning. Okay, so let's quickly start here. So as Vignesh said, our topic is try to generate a regular income from a covered call strategy. Vignesh has given you some background, so we will go deep dive into those background and we will see how it would help. This being a regulated industry, so guys, that's disclosure famous. So everything is here for a kind of education purpose. Although I'm a SEBI registered RA, I can give advice. But for here, being on a public kind of platform on the YouTube, so this is only pure as an education purpose. As Vignesh said about me, I'm a founder for Pasi Technologies, and I'm a co-founder for Sonic Alpha. I'm a SEBI registered RA, and being a trainer, trader, do a lot of blogging, speak on various platforms, and I do write articles for the different media houses. Positivity is mostly into workshops, into live training sessions, and we do have tools. And the Sonic Alpha is more into kind of algo trading. So I will do a lot of agenda for today is we will introduce you what is a covered call strategy. That is the most important thing. And then we will see if we have a portfolio. So how to do something so that we can generate some income from the portfolio. And then in case of a covered call strategy, the most important query that I often do get requests from a lot of guys, hey, how do I select the strike price? Okay. Believe me, there is no white and black answer, but I'm going to give you 10 or 12 different alternatives based on your appetite, based on your personality. You have to select one of those and you can move forward. And then we will talk about what should be the right position sizing, because if you're trading anything, the most important for me is a position sizing. So assume that if I'm taking a trade where my position size is very small, even market moves 5%, 10% here and there, nothing would happen to me. May have a very small loss, but that would be acceptable to me. Versus if I have a huge position sizing versus market just move 1 or 2% here or there, that can have a bigger impact. Position sizing for me is the most critical factor, and we're going to talk about what would be the right position sizing for covered call strategy. Then we talk about some best practices and followed by your questions and answers. Your questions, would be happy to answer those. And in between, if you have, I mean, you get some questions on the slide, do put it there because being a trainer, okay, I do love to interact with the participants. And as and when you get the question, just put it over there. Naresh and the FYERS team would be happy to collect that. And in between FYERS, Naresh, if you see some question which is really relevant, you can ping me in between. I would be happy to answer there and there itself. Guys, let's talk about the when we trade. We normally trade something like a cash. Okay, so for me, if you ask me, Santosh, basically, is cash trading required along with the options of futures trading? I would say for me, if you do a job, okay, so you get two things. One is what you get is a salary, okay. So on month, 10 month basis, you get salary. And then at the same time, if you see there is a PF account where your PF get accumulated, okay. So same thing, similar things happens in the share market here. So for me, I recommend that you should do a cash trading, cash, okay, stocks. You just buy the stocks and keep it those for the long term, and then using those cash, there is you can do the pledging and get the margin against that, and do the options trading or maybe derivative trading. So this would be a kind of a combo for most of us. Okay, so for example, I'm sure here a lot of participants here, I can see around 300 roughly participants are there. So they might have a stocks in their portfolio. Maybe if you guys might have bought 10 years back, 20 years back, and it's keep on you keep on adding those new stocks in your portfolio. So we have a portfolio, but if you're not using it, you are not using it, optimizing it, okay, your resources, then it doesn't make sense. For example, let's take the example. You have a flat, assume that in your home city, you have one flat for you where you're residing, and at the same time you have assume that two or three different apartments are there. So if you bought those apartments and you keep it idle, then it doesn't make any sense. So you have to generate some kind of a rental income from those apartments. Then it makes, yes, that would become an asset, otherwise it will become kind of a liability. Okay, so we don't want to go into a world of kind of liability, versus you should say, okay, I want to generate some kind of a rental income, maybe 1% kind of income, or maybe half a percent of my portfolio. So assume that I have a portfolio of 1 crore. Can I generate a 1 lakh out of that on a monthly basis? Can I generate a 50,000 out of that on a monthly basis? Believe me, if you have a flat, say, assume of 1 crore in some metro cities, you hardly get like 20,000, 20,000 kind of interest. And if you add throughout the year, that would come maybe around 3 lakhs or 4 lakhs, maybe around the higher side of the 5 lakhs. That's hardly generate a 5% ROI if you're lucky enough on your property, versus if your shares worth 1 crore, if you do this covered call kind of strategy, you will have some potential to generate maybe 6%, maybe 9%, maybe around 12% kind of returns based on your appetite, what you take it forward. Okay. So here your asset could be your stocks, which is there in your portfolio, or maybe it is a mutual fund. So a lot of guys, they do a SIP, they have accumulated a lot of funds, units in your account. Okay. So you have to utilize those. So you have a bond, you have a mutual fund, or you have a stocks, or maybe even the ETFs in your account. Okay, so you have to pledge that, and a lot of brokers, including FYERS, allows you to pledge it. Okay, so once you pledge it, they will release a margin in your account so that you can do a derivative trading. So, guys, here what I'm talking, you have your own asset. In fact, earlier days you might have Amitabh Bachchan, they used to come, "Ki ghar mein pana hai, sona hai, so kahe ko dana." So basically, if you have gold at your home, then you should rent it and maybe generate some rent incomes out of that. So that's the agenda for today. So if you have a cash, maybe mutual funds, or maybe bonds, or maybe ETFs, or sometime maybe even kind of some other things. Okay, so you have to pledge it that and get a margin out of that, and then do the derivative trading. And one benefit of that is that you don't have to put a lot of cash for your options or futures trading, because already we are utilizing our own portfolio and then we are trading. In fact, we just need around 20 or 30% cash would be required in case if you want to buy something, especially option buying. But to sell, you don't need any cash. You can use those cash. Although there is recently there is some change from the our regulator, and they said that we need a 50% kind of margin versus cash. That is only required in case if you're keeping the positions overnight, versus FYERS and other brokers, they have given the flexibility that, yeah, and plus if you want to do it forcefully, I mean, they charge hardly any interest, and you can do that way also. Okay, so let's go forward here. Yes,
Sorry
sir.
to interrupt. You need to be a little louder. I have
Okay,
comments, people saying that they can't hear you very well.
okay, is that better now?
I think this should be good, yes.
Okay, awesome. Yeah. So our aim is that we have a apartment and I want to generate rental income out of the apartment. Okay, so that is the whole agenda for this presentation. So guys, here let's say I have a portfolio. Okay, maybe say I have ABC stocks, or maybe let's say Reliance, or maybe HDFC Bank, or maybe say Nifty Biz ETF. Okay, so assume that I have a ETF of around 10 lakhs. Okay, so that is what I'm saying. I have a stocks or maybe a bond or maybe a mutual fund that is worth around 10 lakhs rupees in my portfolio. Okay. I want to do a covered call. Okay. So what happens with this portfolio? If your portfolios are good, for example, like ETFs or kind of a debt funds. Okay, where the price doesn't move too sharply, then our exchange, especially NSE, they gives you some kind of a haircut would be there. So they're just gonna give you 10% kind of a haircut would be there, and the rest 90% would come in your pocket. Okay. So assume that you have a shares worth a 10 lakhs rupees. So 10% would be on hold, and they would release around 9 lakhs in your margin account, and using that you can trade the options or maybe a futures. So that is one thing. But assume that you have some stocks which have can give us some kind of a bigger moments. In that case, exchange will hold a kind of a, I mean, they will block 20%, but 80% would be released in your account. So you're gonna get around 8 lakhs in your margin, and using the 8 lakhs, you can do the options trading. Okay. Same way, if you have some kind of a small, maybe some unknown kind of stocks which is not or maybe the stocks which gives a drastic movements here and there, then there the haircut would be much higher. Now the next question would be the, hey Santosh, how do I get the information about those haircuts? Okay, so you have to go to NSE India and just go to the all reports, the link which I've given there, and there you're going to find two files. One would be for the approved securities. It means for the stocks. Okay, so you're going to see for the stocks what is the haircut. And the next one way, if you are holding a mutual fund, then you go and look for a file called haircut for mutual funds. Okay, so here the approved mutual funds are there with the numbers that there would be a 10% haircut, there would be 20% haircut, and so forth. Okay, so you need to go first here and you see India all reports, look for this. Assume that you have some kind of unknown stocks, then there would be no this facility won't be available for that. But if you have stocks which are mostly under the FNO, then it's easy to get this kind of facility. At the same time, do remember a lot of brokers do they have their own filters also, so they may apply their own filters on the top of the NSA just to protect. Okay. So this is so most important thing is that I have a portfolio and I'm gonna pledge it. So here first I need to see how much haircut would be there and how much capital would be released in my account. As most of you guys would be knowing that normally I prefer to trade ETFs. So in case of ETFs, around 7.5 or 8% kind of a haircut is there. So assume that I have a 10 lakhs thing is capital is there. I would get around 9 lakhs plus around 9.2 kind of a things release margin in my account, and using that we do a trading. I do keep around 10 to 15% as a cash for the MTM management that is required. And if you guys are doing a lot of intradays, then again there won't be much interest that you have to bear. Okay. Next, so assume I have a portfolio. Okay, so it's yeah, as I told you, we have to use optimized use of our resources. Okay, so if you have a big field and if you're not using it, it doesn't make any sense. Assume that I give you a tractor, and if you're not utilizing it, then it's a kind of a liability for you. It's not an asset for you. Okay, so if you have resources, this resources could be a mutual funds, it could be a stocks, it could be a bond. Okay, it could be ATF, then we have to use it. Okay, so here the most easy thing is to do a covered call. Okay, so it is just kind of you have your own apartment and you're renting it to some corporates, some to some tenants, and you're charging a rent on a monthly basis. So that is what the objective of a rental income, and that is nothing covered call. Next is whenever we do the covered call, let's say again example, I have a 10 lakhs rupees and I want to do a covered call. So out of the 10 lakhs, assume that the 10% haircut is there. So in my pocket, I'm going to get 9 lakhs rupees. Okay. to sell a one lot of a Nifty, hardly like 1.5 or maybe around higher side, assume it will be 2 lakhs rupees. So out of 9 lakhs, 2 lakhs is gone for that covered call. Still, I have a 7 lakhs rupees extra in my pocket. So using that, you may, if you're expert, you understand the options trading or futures trading, then you can go for some risk-defined strategies. For example, like iron condos, iron butterflies, calendar spreads, or some kind of a vertical spreads, but not the ratio ones. Okay, so that you can even if you are expert, you can use that. And in case of say earning seasons are there, currently we do have earning seasons. Okay, so, and if you're feared that the result may not be good, it may go further down, then there is something known as a collar strategy, and that is nothing but it's called a long put funded by a short call. So here what happens, we have shorted a call, we got some premiums using those calls, and then I'm going to buy a put using those premiums, and that is known as collar strategy. Maybe we're going to take that in some other occasion. Okay. So today my agenda is to go for covered call. So guys, covered call means I have a portfolio. I'm going to pledge it, and then I'm going to short one call per lot. Okay. I'm going to short a one call, and then I will try to generate a income. This income could be a 0.5% a month. It could be a 1% a month based on your what you do it. Okay. So let's start covered call here. So cover call, as Vignesh said, that we own a stock. So assume that I have Reliance and maybe a one lot of Reliance is there in my portfolio. Then it's like I'm having a one lot of a Reliance in my account. Okay, so that is for me it's a long term investment. As I told you earlier, it is my PF, which is there for a long term. Or maybe most of the time I prefer Nifty Bs. Okay, okay, or maybe Nifty ETFs. So that is there for a long term. So we own a stock which is that we want to keep it for long term, and then on a monthly basis I'm going to short a call. Okay, on a monthly basis I'm going to short a call, and that becomes your covered call strategy. So the definition is very easy. You are owning a stock and you are shorting a out of the money call. Believe me, it's an easy strategy, not too complex. You have to only short one call. That is the covered call strategy. Sometimes if you're an advanced user, you understand your appetite, you understand the options trading, futures trading. In that case, a lot of guys, instead of owning a stock, they would rather prefer to go and long the future. In that case, we have to just pay maybe a 10% or 50% of the actual underlying. And then against the future, those guys go and short a call. Okay. So in that case, that would be again known as a covered call, but using future. Okay. So there are two versions are there. One is covered call using the stock, and the other one is covered call using future. So those are the two different versions are there. For a normal users, intermediate user, I would say preferably go and use a cash. Okay, so covered call using the cash, basically own a stock and go for the covered call, because or going for the future, and if market goes down, then you have to manage your MTM at the same time you do roll over month over month. Okay, that may be slightly tricky if you guys are not aware of it. Okay, so the best to learn the covered call, I would say just buy a one lot of a stock and then do the covered call strategy. Okay, so here the example what I've given. Let's say I have some shares which is currently trading at 1,000 rupees. Okay, and that is there. In that case, I'm owning a stock at 1,000 rupees, and then on a month basis, I'm gonna short a call. Okay, I'll give you idea what a calls to be shorted. It's much easier. Although there are a lot of variations are there, and where a lot of guys do get confused. So in this webinar powered by FYERS, I'm going to give you one at the end. I mean, I'm going to show you 10 to 12 different methods, but at the end, I'm going to give you one most simplest method where you don't have to see the chart and you can do the covered call strategy. Okay. Guys, if you go to the NSE option chain page, we do see this kind of four blocks are there. Okay, so one would be yellow color, one would be white color, then we do have a yellow color, and then we do have a white color. Okay, so whenever you're doing the covered call strategy, you have to focus on this area. So you have to focus on the white area on the left hand side. Okay, so that's just my candidate. The things which I want to short, that would be over here. Rest everything you have to ignore. Okay, So remember here, if you're doing the covered call, we are talking about out of the money call. So out of the money calls are the one on the left hand side in the white color. Okay, so just go to NSE, whether you're using NSE new option chain page or you're using NSE old option chain page, you have to see the one which is in the white color. So here you have to identify, hey, I want to short 18,200, I want to short 18,300 call or 18,400 call, 18,500 call. That I'm going to answer you, but our answers will be one of this. Okay. So out of the money calls, I'm going to ignore the rest everything on this page. I hope that's much easier, guys. Okay. Next one is let's see. Hey, Santosh, I want to do the covered call. Give me some example. So here the thing is, uh, say here a stock is there, which is currently trading at around 1,000 rupees. Okay, so this is a stock which is at 1,000 rupees. So assume that I'm just holding a stock. Okay, so the stocks may go up in few months, it may go down, those things are there. So we do get some kind of a linear diagram is there, payoff is there. So it can go up, it can go down. If my underlying goes on 5%, I'm going to have a loss of 5%. If my underlying the stocks goes 5% up, I'm going to have a profit of 5% in my pocket. So that is known as a linear payoff, okay, where you go one way up or you go one way down. Okay. Now what I'm going to do here, hey, I have this stock in my pocket. I want to do a covered call. Okay, so what you do find out? The stock is currently at 1,000 rupees. So first of all, your strike would be more than 1,000. It can't be lower than the 1,000. So I'm not going to talk anything below 1,000. So you have to identify the call which is above 1,000 strike. So in this particular example, I was trying to identify, hey, this particular stock is at 10,000 rupees. What is 1% of 1,000? That's 10 rupees. So I thought, okay, 10 rupees is 1% of 1,000. So I try to identify which strike is trading at the 10 rupees. So what I got is like a 1060. Okay, what I got it here, guys, a 1060 is or maybe let's consider 1050 or whatever, 1060. So assume 1060. I got it that 1060 is trading at the 10 rupees. So I was really happy. So what I did, I'm owning a stock, and on the monthly basis, I went out of the money, and that I got it 1060 call, which is trading at around 10 rupees. So I went ahead and I shorted that. Okay. So this is my scenario that I'm owning a stock, and you have to forget the old price. Okay, you have to see what was the price on the first day of the new series after the expiry. Okay, so we're going to see on the Friday, hey, for this series, what is the LTP of the stock? So I identified that currently the LTP of the stock is 1,000 rupees. So I thought, okay, what is 1% of 1,000? The most easiest calculation. I said, okay, remove the last two zeros. So that's a 10 rupees. I said, okay, let me identify the stock which is currently trading at 10 rupees. The strike which is there at 10 rupees. So we have got the answer that it is 1060 over here. Okay. So this is first of all a 6% away from the current price. Just remember here, because it's 1,000 rupees there, and this is at 1060. So roughly it's a 6% away from the current price. So we are shorting a call which is roughly a 6% away from the current price. So guys, let's see what are the possible outcomes. Okay, so if we are doing this kind of a method, there would be maximum four possible outcomes would be there. Okay, so first is that market remains at 1,000 rupees only. So today, the first day it was 1,000. In between the series, market went up, went down, and on the expiry day, assume that it expired at 1,000 rupees. So Vignesh, what will be the possible outcome here? Can you guess? Or maybe any users, can you guess what will be possible outcomes? You can put it on the chat. Okay. So we took a stock. We have a stock in our portfolio on the last first Friday, or maybe after the expiry. It was trading at 1,000 rupees. We went ahead and we have shorted a call which was at 1,060, and throughout the month market went up, went down, and it expired at around 1,060 only. So what would be possible outcome of your underline? First of underline remains same, everyone agree with that, because at the start of the series it was 1,000, at the expire it's 1,000 rupees. So our underline didn't move, we didn't got any profit from the underline, but short call, we will get a profit or loss, guys. Here, what do you think? You're gonna get a profit. And what is that profit, guys? That is a 1% of your portfolio, guys. That is what? 1% of your portfolio. Okay, so it means a lot of the other traders, they didn't got any profit, but you guys were lucky and you got 1% rental in your account. So that is the first possible outcome. Does it make sense to go for covered call just for this method, guys? Yes or no? We're gonna see other scenarios. Okay, so this is one scenario. Now, second scenario is that hey, I took this stock and market went 5% down. Okay, so it was at 1,000 rupees and market tanked. My underline this asset, and it went down by 5% and say it closed at 950. So what is the loss in underline for you and for the other guys? 5%. Everyone agrees with that. So the loss would be what? 5% for a lot of the guys. But what about the one who's doing the covered call? He got a 5% loss, but he got a 1% return on covered call on a short call. Okay, so for him, the loss is 1% less compared to the other guys. So let market tank by 10%, this guy would have a 9% loss. If market goes down by 2%, this guy will have a 1% loss. Okay, so the beauty is that two scenarios, it saved you. If market goes down, still you're going to generate 1% income. If market remains there itself, you're going to generate a 1% return. So does it make sense until now to go for the covered call? Guys, if you answer me fast, I'm going to add some more toppings. Okay. Yes, perfect. Okay, now let's say market went all the way at 1060 and it expired at 1060 itself. What will be the possible outcomes? So your underline would increase by 6%. So you're gonna get a 6%. Plus you're lucky enough because market expired at 1060, your strike only. So you're gonna get a 1% return from the short call also in your pocket. So in your thing, it would be a 7% portfolio increase versus for the guys who have just bought the cash stock in their portfolio, they're going to have a 6% return. So we have seen three scenarios where if market goes down, it's going to help you. If market remains at the same level, it's going to help you. If market goes slightly up until your short call strike, it's going to help you. Okay, but little bit away from the shorter strike is going to help you. Okay. Or let's see the other scenario that market instead of moving 1060, it moved to 1100. Okay, so I'm saying here you thought that market will not go 6% up in the series, but market ended at 10% up in a series. So my question is that how much the other guys will get returns, guys? The one without the covered call in their portfolio, they will get a 10% return. What do you think in your case? What do you think in your case? The answer given by Anna, that's a 7% absolutely correct because market went a six. First of all, we shorted a 6% upstrike plus we got shorted a call of 1%. So a lot of guys, the other guys, they got a 10% in their portfolio increase versus we got a 7%. So guys, my question is that did we got a loss or did our net worth went down with this approach? Yes or no? No. Okay, that's the beauty of this approach. Although what happened here, we lost the opportunity to gain a 3% extra. So here we had an opportunity lost. So that is only things can happen with the covered call. So when you're doing the covered call, occasionally it may happen that you're losing some opportunities. But believe me, in all the scenarios, your net worth would be slightly better compared to the other guys except for if market becomes super bullish. Okay, so there we're gonna have some kind of a opportunity loss, but in that case also your net worth will increase. Does it make sense, everyone? Now, so are there any possible fifth outcome? Anyone guess? In fact, there is no other fifth outcome. These are the possible four outcomes that market remains there itself. Market goes down, market goes slightly bullish, and market goes strongly bullish. So only the problem comes when market goes strongly bullish. So that is where we will have some kind of a opportunity loss, but it won't be a loss in your account. Okay, make sense, everyone? Now, my question is that how often that market becomes super bullish? Maybe once in a kind of a year, or maybe once or twice in a year. Not always it becomes a super bullish. Okay, so most of time this strategy, covered call strategy, would help. So you're gonna accumulate 1%, 1%, 1% kind of thing in your account. So out of like 12 months, maybe 8 months, maybe 6 months, you're gonna add something, and maybe a few months it could be break even, and you may, if market becomes super trending, then you might lose the opportunity. For that, we have some kind of controls that we're going to see. Okay. So guys, does it make sense until now? I hope you guys are able to digest. If there are some doubts are there, just put it on the chat. Otherwise, I'm going to move forward. Okay, so perfect. So about the strike, I'm gonna see the next strike, next few slides, how to go for strike. Thank you, a lot of guys for positive feedback until now. Let's move forward. And here's the example where I've shown you all those calculations that, in fact, you guys say 7% return. This is the way the 7% return would come in your account. Okay. Now let's, excuse me. The most important question, in fact, I've seen in the chat also, guys were asking, hey, Santosh, how do I select strike rate? Okay, and this is where a lot of novice guys or newbies in the option was, when they learn about the cover call, they get confused. Okay, so I'm going to start with the strike. Initially, I'm going to confuse you, but I'm going to give you the easy answer also. Okay, so let's move forward here. The answer is all this. Okay. In fact, this is a short list of the answer, but you might have get. I mean, you can add few more in the list. Okay. And guys, so first is to identify the strike using the resistance. Instead of writing a resistance, I'll say, what is your target for the month? Okay. You may even say that. Assume that instead of resistance, you may say target for the month. Okay. That underline target for the month. Okay. So you can say underline, assume that I want to get rid of that stock. Okay. In this month, I want to book a profit. So what would be possible or target of the underlying in the month? Okay. So that is the first one. The second is you may use, if you are technical, you understand technical analysis, you may use something like Bollinger Band. Okay. So you can see where is the standard deviation 2, and maybe you can keep that as a target, and you can go and short that. The next one would be using the standard deviation. Okay. So like a lot of tools, including the option oracles, it gives the standard deviation. So there are two ways to calculate standard deviation. One is just using the underline. I would say don't use that, because in case if you just using the underline, the problem is that it doesn't know when it expires. So we have to say, hey, I want to use a standard deviation where I want to be consider the number of days to expiry, that I'm going to hold this covered call for next 4 weeks or next 5 weeks, or maybe 20 days, maybe 30 days. Based on that, the calculation would differ. Okay. But normal standard deviation would only consider the price, and then it doesn't consider the number of days you're going to hold. Okay. The next slightly difficult one is ATR. That is nothing but that is an average true range. So using that, you can say, hey, my average true range is 100 rupees. I want to hold this the instrument for next, for the 4 weeks. Okay. So just do 4 times or 3 times of your ATR. That would help you out. Next one be based on the delta. Okay. This is especially for the guys who understands the option Greg's delta, Vega, theta. So using the delta value, you can go and you can short the, or you can select the strike. Next, the recommended way is use the max Y. Okay, so for the particular series, wait until the Monday, see what is the max, where is the strike where we can see the max Y on the call side. In fact, I'm not going to say call side, I'm going to say max Y at the call OTM. Okay, so if it is at the money in the money, I'm going to ignore that, but I'm going to use a call OTM. Okay, so in fact, I'm going to say OTM call. That would be much better. Okay, and then there's something known as a straddle price. Okay, so here what you do, we go to the ATM strikes, and we're gonna select what is the premium there, and then based on the premium, we're gonna identify where is the break even for that, and that break even would actually become a strike to short the call. And then finally, my most easiest, the way I recommend is use ROI, the expected returns what you want. This is the most easiest way. Okay, so we're going to start with the difficult ones. You guys able to digest the difficult one, follow that. Otherwise, come down to the last one that is based on the ROI expected. Okay. So guys, I hope until now things are going good. Confirm me on the chat. Hey, awesome. Perfect. Thank you so much for the confirmation. So let's move forward here. And then the faster you answer, if I get a more time, I would go. In fact, we are already at 5:50. Okay. So I would go. I will show you the examples also. Otherwise, we have to go on the uh, 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 slides and we have to cover that itself. Okay. So let's slightly go faster. The next one is you may go on the chart and identify some turning points. So that is what a resistance. So this is one way. Hey, I mean, this is resistance. So I'm going to sell a strike which is somewhere over here. Okay. So based on like this particular example, I can say, hey, market is currently here. Maybe I would prefer something like 1120, or maybe I want to go very safe. I would go 1160, or maybe if you want to go very conservative, then 1190 would be one strike. Then you can go ahead and short. Or maybe you can say, hey, I'm holding a position, and if I want to get out of this position in a month, what is my possible target? Okay, in a month, okay, on the expiry day. So you may say, hey, my target is this thing, my target is 1200, something like that. So you can go and short a call of your target. Okay, that is one thing. We are not actually getting out of your underline, but assume that I want to get out the underline, then that would be the strike or target. Okay, so based on that, you can go ahead and short a call. Difficult one. I don't recommend this. We'll move to the next one. Next one is using a Bollinger Band. Okay, so you can go and add a Bollinger Band in your chart. Okay. Most important thing is go and use daily chart and use a Bollinger Band, standard deviation 1 or 2. And based on the standard deviation 1 or 2, you identify the strike. Hey, currently market is somewhere here, and I want to go and one strike. Okay, so based on that, you may go ahead and shorter call. Personally, I don't like even this because normally I avoid to say charts. Okay. Next one is you may go. In fact, our tools give you the standard deviation. Okay. I told you there are two ways of the standard deviations are there. So we have an option oracle, and if you see at the top, it gives you that standard deviation -2, standard deviation -1, standard deviation +1, and standard deviation +2. So +1 means most of you guys must be knowing that standard deviation 1, sigma 1, that means around 65.6% chances there that this trade would be in your favor versus other things, it won't be favor. Okay. So here what we're going to do, we're going to find out the strike which is near to this one, maybe 18,600 or maybe 18,700, go and short that. Okay. So remember here, this tool would show the standard deviation for the expiry. So you have to make sure that date over here is the expiry date. Okay. In fact, here it shows the expiry. In between the chart, it shows you on a selected date. So whatever is written at the top, that may be considered. And you have to identify the strike which is near about that strike, and you can go ahead and short a call. Okay. Next, ATR slightly complex method is there. So you have to go and add an indicator ATR in your chart, and it's going to show you some value. Let's say it's going showing me a 200 as a value. Again, a most important thing is that go and see only daily chart. Avoid hourly chart, monthly chart, weekly chart, those kind of things. Just focus on a daily chart, and then you have to get this number. So assume this number is 200, then I'm going to say, hey, this is currently the ATI is 200 is there. So for me, how many weeks are there for the expiry? It's a 1 week away, 2 week away, 3 week for the monthly expiry. So assume the total number of weeks are four weeks are there. So in that case, what I'm going to do, I'm going to multiply 200 into 4. That becomes 800. So wherever is the strike plus current price is there, add 800 to that. You're going to get some number and you're going to short that strike. Okay, so that is a 8-year based method. Although there are a lot of if and buts are there, but this is the most easiest way. Okay. Next one is you can go to using the Greeks, especially like data. So in the option oracle, you can see that we do have a data over here. As you guys can see, right, my mouse is moving over there. So based on that, you have to identify. So a lot of global traders, they identify a delta which is around 20 or 25. Okay, so 20 delta means 80% chances market will not reach there, and 20% chances market will reach there. Okay, that's the meaning of that. So identify here a data. So you're gonna see some decimals here. So identify the one which is below zero point 0.2. Okay. So like you can see, this one is below, maybe over here is below point. The first one which is very near to zero point 0.2, okay, or maybe 0.25. So let's say this guy is below 25. So I'm gonna identify this strike and let's say 18,450. I'm gonna go and short a call of 18,450. So what it means, 75% chances that underline will reach to this number, may not reach to this number, and 25% chances that market may go and touch this number. Okay, this is again a complex method. Personally, I even don't prefer to go on the data method. Okay. Next one is you have to identify max Y. So this is most relevant. Okay. So here you can go to the option chain page, but thing is that don't do this on Friday. Because Thursday is the expiry, next is a Friday. So a lot of guys may not roll over the positions. So it may not show you the right OI. So in this method, what happens? I'll prefer to wait until Monday or Tuesday. So on the Tuesday, first Tuesday of the series, I'll go here and I'm going to check, hey, where is the max OI in the white area? Again, the most important thing is you have to identify on the left hand side. Okay, so ignore the right hand side here and identify where do you see OI and the max OI, as you can see somewhere over here. That is a 18,500. So in this case, I would be happy to short a call of 18,500. Okay, so that is my method. And this is a recommended method, most relevant out of the earlier ones which we did, because there's a lot of subjectivity on the earlier method. For example, if you see the chart, then this is the way you predict. Okay, so I would say everyone will have a different understanding of where is the turning points. So you guys may assume that this is the turning points. You may say this, you may say this gap area, other guys may say this. So there's a subjectivity element of the subjectivity is there. Here, a lot of guys may say, hey, I want to go for delta one, but thing is that sometimes a Bollinger band narrows, sometimes it widens. So again, based on this Bollinger band, this guy doesn't know that my expiry is 10 days away, or the expiry for this is 20 days away. So that is the element which is not there for this Bollinger band. So I don't like using the Bollinger band. This again is standard deviation. This is slightly relevant because it do consider that the expiry on so and so forth. So slightly relevant, but thing is that one standard deviation is too safe. Okay, so sometimes too safe is also not a good method. Okay, so one standard deviation means market is currently at if you see here is somewhere around 100, and this guy is saying 600 186 18. Okay, so 18,600. So sometimes too safe, it means if you're going for too out of the money, then you may not get a relevant premiums, and then again it doesn't make much sense. Okay. Next one is ATR. Again, ATR, I would say slightly relevant because it does consider how much the current volatility is there in the market. And then you have to say number of weeks it's there and do the calculation. But again, some mathematics are required. A lot of guys may mix up here. Instead of considering a daily ATR, they may consider a hourly or maybe a weekly ATR, because they will say, hey, total, there are 4 weeks are there for the expiry. Let me go and find out the weekly ATR and multiply by 4. That's not the method. Next one is the lot of guys, university have seen they prefer to do this particular method where they identify a delta which is around 0.25 or lower than 0.25, and they would go and sell. It works in the global market like US kind of market, but somehow like I don't like it because we go too out of the money. Okay. Next one is here max Y. This is the most relevant for me because we see how much open interest is open on the OTM side. Because if market goes here, these guys would generate a lot of hurdles to move market further up. Okay, so these burgers would go and like they will just collapse. It will fight. Okay, so that's the reason I would prefer to go for this method. But the only catch is that do only off Monday or Tuesday. Don't attempt on Friday because rollovers might have not been completely over. Okay. Next, if you're using the option Oracle R tool, you don't have to go to any this page, but directly you can go in the option and on the chart title itself, it's going to show you, hey, you go for 18,500. Okay. So it's going to show that this is a strike, but make sure two things, that the expiry is correct. So you can go over here and change the expiry. So you have to go and identify the monthly expiry, and on the monthly expiry, whatever number shows here, that you have to consider. So don't go and mix up like a weekly kind of expiry, because we are going to trade on a monthly contract, not on the weekly contract. Okay, so that is a catch. So focus on that. Same way, if you're seeing the option chain page, again, don't go blindly over here. Go and change the series to the monthly series, and then only do these things. Okay, so don't do those kind of goof off. Okay. Next one is a straddle method, slightly tricky if you do the manual calculations, but I'm going to show you that. So here you have to identify what is the average price on one white and one yellow. Okay. So roughly, let's assume the my roughly price is say around 180 here, and then you will identify, hey, what is the average price of this? So that's around maybe 160. So 180 plus 160, you have to say, hey, 180 plus 160, that's around 320. So add 320 to the current strike, or maybe the one which is in the last yellow, or maybe first white strike on the call side. So 18150 plus the average of this. So the average of this plus average of this, and that you strike, add to that, and that may come maybe 850 or maybe 500 or whatever number comes. You have to go and trade that. That is kind of a slightly conservative kind of things, but can be done. If you think, hey, Santosh, this is too complex for me to digest, then you can use any option strategy builder and just go and click on the template here and say straddle strategy. Okay, so we're gonna short the straddle strategy. I mean, we're gonna go for a short straddle strategy, and on the upper protection, not on the lower side. Okay, on the upper protection, you have to see where is the break even. Like here is showing that break even is around 18 500 or whatever on the upper side, not on the lower side. So upper side is somewhere over here. That is 18,450. Okay, so you have to go here at 18,450. Went further down, so you have to go here on the upper one, and then you have to upper protection. You have to go and trade it. Okay, so not the lower side. Okay, also bring up. Yes, yeah. So you have to identify what's your upper protection. As we can see, the upper protection is 18 for some 449 or something is there. So you have to identify the strike which is near to this number, and you have to go and short. So that becomes much easy. In fact, this is again one of the relevant method. So max OI, or you can even go for this straddle method. So straddle premium. Okay. And then most for me, most easiest method is based on ROI. So let's focus here, guys, because this is very easy, and a lot of guys, if you don't have a deep knowledge of options, also can implement this method. Okay, so here what we're gonna say, we're gonna say, hey, where is the LTP? So we're gonna say that currently the LTP would be somewhere between 18100 to 18150. So let's assume 18100. Okay, or maybe 188 150 or whatever number. Let's assume 18100. Okay, so I'm going to say, hey, what is 1% of 18100? Can anyone put it on the chat? What is a 1% of 18100? Yes, 18100. What is 1%? That's 181. So go in the OTM white area only and identify the LTP price, which is around 181. So which one is that, guys? Here in the screenshot, that you can see 18500 or 550 kind of things, where it is trading in fact 18550, and it is trading near 181. So this would be for me a most easiest method. So guys, in this particular method, do I have to see the charts? Say yes or no. Do I have to do a lot of Greek calculations here? No. Okay, do I have to go and do some kind of a statistical analysis like standard deviation, those kind of things? Absolutely no. Okay, so this is a more serious method. So let's do this, and we're gonna do a on the current symbol. So guys, you which symbol you want to try here? You put in the give me any stock, and we're gonna do the same exercise for that stock. Yeah. Okay. Let's see what is the majority is until now. I got Nifty, HDFC Bank. Okay, let's go and do the HDFC Bank. Okay, so we got two guys saying the HDFC Bank. So what I'm going to do here, I'll go on the NSE option chain page, and we will open the HDFC Bank. So what I'm going to do here, I'm going to write here HDFC Bank. Okay, and let's say go, and we can see the ATP is a 1659, guys. So help me out. I'm very weak in the math. Just assume. Then what is the 1% of 1659? I hope you guys are able to see my screen. Yes. So 1% of 1659. That's a 16 rupees, not 166, guys. Okay. So that's around 16 rupees. So let's go, and we will trade for the next series. So let's go and for the February 23rd expiry. Okay. And let's identify the strike which is near 16, guys. You have to answer me. So tell me which is the strike you would prefer to trade. So this is the LTP price. So which is the strike that we prefer to trade? We can say we can go a 1720 would be much preferred one. Okay. Or maybe, yes. In fact, I would prefer 1720 for various reasons. Guys, can anyone guess why I would not go for 1710? Although I can see Prashant Kulkarni and a lot of other guys, they said 1710. I would prefer to ignore that. Can anyone guess why? If you see the bid and ask price of that, that's a huge spread. That's a 15 rupees and 21 rupees. Very good. A lot of guys did answer correctly. So beer and ox is white. I would not prefer. So here I would prefer a 1720 because 1 rupee bid ox is there. In fact, the most beautiful numbers would be like 1750, but then this is too cheap for us. So either you can go aggressively something around the 1700, or you can go and do a 1720 strike. Okay. So that is what uh, can be done. Okay, guys, perfect. So let's go. And a lot of guys did ask for the other symbol. Okay, so guys, let's make a chart here. Okay, and let's see what happens. So assume that I took this trade. Okay, so what is the possible outcome? So guys, if market stays here, tell me what is the possible outcome. So throughout the series, HDFC Bank. So I'm gonna open a chart of HDFC here. HDFC Bank, as you guys have said, I'm gonna open that. Currently, market is somewhere around. Uh, I'm going to open a daily chart, not the hourly chart. So that's my daily chart over here. And I'm going to scroll slightly down. Okay. Yes. And guys, so tell me what would be possible outcome of this trade? Tell me, guys, can anyone guess what will be possible out if market stays here? Anyone? If market stays here, give me two outcomes. One is underlying outcome and one is option outcome. What do you think underlying? If market stays throughout the series, there is no gain in your portfolio, but in the options, you're gonna gain 1% roughly. Okay, so in that case, you have earned a 1% on your portfolio. Okay, so if you're holding a one lot of HDFC Bank as a share in your account and you follow this method, and throughout the month, if market remains below 1720, okay, if market remains below 1720, you're gonna earn 1%. So let me go and make a line here for 1720. I'm going to add that line over here. That is my target for the month. So I'm going to say 171720 strike, the one we have selected. So assume that the market remains throughout the month. If market is below 1720 or comes down to the same price, portfolio wise, there is no gain, no loss, but options would give you 1% return. Okay, so that is one possible outcome. Let's say Bank Nifty instead of going up, it goes and expires maybe a 1%, maybe a say 2% down. Okay, so let's say it went and expired, let's say 4% down. So 4% went down. So what would be the outcome for you guys? So 4% down, market went down. So for the lot of guys, you will have a 4% loss, but for us, it will be 4% minus 1% because we have earned a 1% from the short call. So your losses would be 3%, but for a lot of other guys, it would be 4%. Now let's assume market went and you were too lucky for the series. Okay. And this guy went all the way and hits just your target. Okay, that was 1720. It didn't went above 1720. Thing is that you have chosen this 1720 based on max OIs. Assume that, okay. So in that case, what will be the outcome? So market went up by 3.5% underline. What will be your outcome, guys, here? Everyone. 4.5 Rakesh, Rajesh Ji, absolutely correct. Shukant, absolutely correct. Harish, everyone out there, everyone is right. You will have a 4.5. And for the guys without the covered call, they will gain only 3.5. Now let's say the bad situation and market went up not 3.5%, but goes by say undo and goes up by say a 5% on the expiry day, or maybe six. Let's assume 6% on the expiry day. Okay, so your the guys with the things they will gain a 6% in their portfolio. How about you guys? It will be 6 minus a 1. That would be around, yes, that will be 5% gain. Okay. So again, believe me, you might get a loss 1% in your account. I mean, on your short call. So don't be scared because your net worth has increased. In fact, normally I say before a short call gives you a loss, okay, it has to give 3.5% profit in your pocket. Okay. So you're gonna get around 4.5% minimum profit in this thing. Okay. So let the market goes up, but 4.5% or maybe slightly higher would be your profit. Okay. So that is the thing here. So our exact answer would be 4.5%, not a 5%. Okay, that you can see from the option oracle, you can make a payoff and you can see that. Before your short call gives you a loss, HDFC has, as a portfolio, has to give you 3.5% profit in your account, plus your break even of short call 1%. So that becomes 4.5%. So first, before it gives any loss, it will give you a 4.5% profit in your account, guys. So does it make sense to go for the covered call? If yes, then I'm going to add some more masalas. Guys, in all the four scenarios, if you think there are some for other scenarios, let me know. But does it make sense? So assume that you have a one lot of HDFC Bank in your account. I would say go for this. Okay, that would be much better. Okay, thank you for so much feedback. And let's quickly move. Okay, ahead. So I think this is I've given example. This is good enough, or do you guys want me to add one more example here? So even if it goes 10%, if you guys they said if it goes 10%, still you will have a 4.5% profit in your account. Okay, there would be some loss in short call, but your net worth would be higher. Okay, so a lot of guys are saying Nifty. Okay, let me go on the Nifty. Open a Nifty chart here and let's check it out. Nifty here, guys. Okay, so that's the Nifty. Make sure you're seeing the daily chart, and then first things we're gonna start with the option chain. So let's go and open the option chain here, guys. So let's see the for the Nifty. Okay. Now for the Nifty, I'm gonna go here and we're gonna say index Nifty here. One more example here. And guys, tell me what's the Nifty trading as of now? 1827. What is the 1% of that? Quick answers, guys. We are already above our time. Otherwise, fires would fire me out. Okay, from this webinar. Okay, 180. So let's go here, and you guys can, and we will go for which series, guys? February series, because hardly one a few days away the expiry is there for the January series. So if the expiry is like 1 week or 2 week ahead, just ignore that and move to the next series. If there is not enough liquidity, just relax, enjoy time, and once you get the enough liquidity, then trade. Okay, so I'm going to go for 23rd Feb, as most of you guys said. Now tell me 180. So find out first white color on the left hand side. Only that. So we can see white color is there. Do you see anywhere near about 180? Just one below 180, which is the strike, guys. That's 18,400. Awesome. So we got few guys, Mojib and Avdesh, Kataria ji, and a lot of guys. They said 18,400, and that's the right answer. So we'll go on the here and we're going to short 18,400. Then go just to see, just go and add a line here and say 18,400. So that's your target. Okay, so 18 uh 400. In fact, our target will be not 18,400, guys. What will be our break even? Can anyone guess? what will be our break even. So this will be a stop loss, but where would be our break even? Okay. So what do you have to say? You have to go and you have to say 18,400 is the strike. Okay. What is the price of that guy, guys? What is the price of 18,400? 181 or roughly 180. So add 180 to this guy. Okay, so I'm going to add 180 to this guy. So in fact, you will not have a loss until market goes all the way to 18,580. Okay, so let's go 18,580. That's my second break even. I mean, after that, the loss may start in the options. Okay, so 18,580 is the extreme. So see it here, guys. So until market goes above 18,550, you don't have to worry. Okay, so let's say how much 18,550 is away from the current price. Okay, so first of all, if market remains at the same position, you're gonna have a profit. Market goes down, your losses would be less compared to the other guys. Market goes all the way to 18,580, still you will have some profit. I mean, a good profit would be there, and 18,400 would be the highest profit would be there. And if market goes all the way something above, then still your net worth will increase by 3.3%. By hook or crook, whatever happens, your net worth will increase by 3.3 if market goes super bullish. Okay, you might get some losses in the options. Okay, but still your net worth will increase by around 3.3 for sure. Before the options gives you loss, underline has to give you 3.3% profit, guys. What do you think? Good or bad? Okay, now next question. A lot of guys may ask me, hey Santosh, how do I do a Nifty covered call? Guys, so because Nifty we cannot hold it. Can anyone guess? Due to the Nifty covered call, then what is my underlying asset? Yes, our NR he wrote it correctly. It's a Nifty base. So you have to buy Nifty ETF, and that would be around 5,000 quantities of Nifty base or Nifty ETF. Okay, so once you hold a 5,000 of Nifty ETFs, it means you are eligible for one lot of Nifty. Okay, so that's the right answer, and let's move forward here. Okay, in our presentation. And next one is position size. So as I told you, if I'm holding a 5,000 of Nifty base, it means that is equal to one lot of Nifty. Then what is a how much quantity call I should short? So the answer is always 1:1. Okay. So if you're holding a one lot, then always go for one lot. Don't change it. Okay. I have seen a lot of guys when they go into the loss, they unnecessarily they add further a short calls. That is absolutely a wrong thing in case of a covered call. Covered call means number of units or loss you have, the same number of loss should be there in your short call. Okay, so don't over trade, over short a short call. Yeah, that's NR absolutely correct. So if you're holding a nine, because if you say NR 9 lakhs, why? Because market is currently at around 100 and multiply by 50, so that will give around around 9 lakhs. Okay, so that is similar amounts would be there, or the slightly higher would be there because there would be some premiums for Nifty ETF because of those dividends. Okay. Technically, it would be maybe around 10 and a half to 11 lakhs would be there. Excuse me. Yeah. Does it make sense, guys? Okay. So if you're holding a one lot of, let's say HDFC Bank, okay. So whatever loss are there, you need to have that much shares in your account. So for example, HDFC, let's open over here and I'm going to click here HDFC. Right. And let me see over here. And for me, it does looks like the lot size is around 550. So you need to have at least 550 units of HDFC Bank in your account. Okay. So if you have one lot, I mean, 550 shares of HDFC Bank, then you are allowed it to go for short, one lot of HDFC short call. Nifty Bees is actually a Nifties. Okay, indirectly it's a Nifty. So it is like they kind of a, you may assume a kind of a mutual fund, but then it is you don't have to pay like those kind of things. So around 180, 190, maybe around 200 would be the current price. Okay, around 193. So you can go and search here. Let me just search for you guys here. So you can go to NSE, and if I'm correct, around 190 plus should be there. I do hold a lot. Disclaimer: I do hold Nifty based in my portfolio. Okay. Yes, okay. You can say Nippon ETF. This this is not a kind of recommendation. Just do your due diligence before you buy. Okay. So the current price is around 197. I hope NR, I have answered your questions. And there's a question from a guy, Nizam Sheikh, okay. And he said, can we do with the futures? Of course, you can do with the futures. So at the start of the session, I said there are two ways. One is covered call with the cash or covered call with the futures. But if you're doing the futures, you should understand the way futures behave. So until market goes up, it's much easier. But if market goes down, then your future would go down. So you need to have some funds for the MTM management, okay, and then rollover cost would be there, so that you need to manage, okay. For Chandrasekhar, if you have a, let's say, calculation, so if you say 197 here, guys, the current price of Nifty base, the calculation is that roughly 197 into 5,000. Does it comes nearby uh, one lot of a Nifty? So you can see the answer is 98,500. Now let's say, this one. So 9 lakhs 85,000. So what I've said, Nifty bees, if you are having a 5,000 quantity, it is equivalent to one lot of Nifty. And if you see here, 11, currently Nifty is around 18,100 roughly into 50 is a lot size, so that's 9 lakhs. So there is a slightly a premium is there around 80,000 worth of a premium is there because of the earlier accumulation of dividends. Okay, so that's the reason it will be slightly higher. So if you're holding a 5,000 quantity of a Nifty base, then you are good enough to go for one lot of a short call can be done. Okay. So if you're holding a 10,000, then you are eligible to go for two lot shorting a call out of the money. Okay. I hope I have answered Nazim ji. Nazim, your second question, that comes a lot of beta would be, you need to add that, and that becomes slightly complex. Okay. So there we don't recommend. We say is if you're gonna go, so just you need to have it in proper underline. That will be much much better. Yeah. No. So now question comes, hey, what do I do the calculation? You don't have to do the calculation on the Nifty ETF price. Always go for the option chain. So in the option chain, we're gonna see what guys here. We're gonna see a Nifty price. So just at the start of the series, see what is the price here. Consider that as a base price. Don't consider the base price that you bought it earlier. Okay, so at every Friday or maybe on the Monday, Tuesday, just see what is the current spot price and get a 1% of that and short that. That's much easier. Okay. Don't go for the Nifty base price or maybe the earlier your accumulation price that is not required because we are trading at the current market. Okay, so based on the current spot price. That's the right answer. Okay, guys, so let's move further ahead and let's see, and then we're gonna close. We already overshoot the time. Okay. Otherwise, next time fireworks or Santosh, you're not allowed. Okay. So first of all is avoid over position sizing. So as I told you, this is most critical for us. So if you're owning a one lot of underline, then you are allowed it to do only one lot short call. Okay. So that is most critical. Otherwise, if you can't do this, avoid a covered call. Okay. Next one is normally I prefer to avoid some volatile stocks. Okay, the stocks which goes crazy, maybe too much up or too much down. Those kind of things. I prefer that. Next one is I'm going to give you a trick here. Especially a lot of guys did ask, give me. I mean, they have answered a lot of questions here. They did ask a lot of things. So we have to sometimes we have to pause also, okay, and sometimes we have to reduce our portion sizing, okay. So thing, let's say here, okay. So I'm gonna just give you the example here. My aim was to earn 1% of the Nifty base guys here. So what I'm gonna do, I'm gonna go here in the Nifty daily chart, and I'm gonna see, hey, where is the RSI? If RSI is above 60, okay, somewhere is above the 60. So let's say over here, from here it just went here and 60. In that case, Above RSI above 60 means what, guys? Can anyone answer me? RSI on a daily RSI is above 60. What it indicates? It indicates that there is a strong bullishness is coming into the underline, and we can see that market went up strongly up. So in this case, if you do a covered call, it may go and hit your target strike. Okay, so what I'm going to do here, if I see that something is going above 60, so instead of earning a 1% for that particular series, I'll say, hey, I want to earn half percent of that. So I'm going to identify 90 is the half percent. Instead of shorting something above, I'm identify which is 90 and I'm going to short that. Does that make sense, everyone? So here, instead of a target of 1%, my target will be reduced half a percent. Okay. So in this case, I'm hoping that I'm going to get a good returns in my underlying and less return on my rental. Okay. So yes, and Anna, that is excellent. I mean, consider, yeah, this is absolutely excellent concept. I like it. Okay, so hope you also can implement that. Okay, so that is the most critical thing. And in between, if you are taking a trade and you are monitoring day in day out, so whenever in between also, if you say that initially when took the trade, RSI was here, as market went up here, immediately go and close that and go for the half a percent target. So that is a in case you want to do aggressive management of the cover call. There are a lot of ways out there that can be done. Believe me, there are for hundreds of ways to manage the covered call. But we are already overshoot the time almost by 50% extra premium. Okay, we took it, and I would love to close the session here. Let me see if there are something there. So guys, another 10 or 15 minutes for your questions. And Vignesh, you can read the question, which are the important question. I'll be happy to answer that. If you are there, Vignesh.
Yes, of course, sir. Right here. I've been listening to the whole all the questions that have been coming in. We've got questions pouring in on YouTube as well as on Zoom as well. So that is
Okay.
option at the bottom of Zoom. So if you
Mhm.
click on that, you'll see a lot more questions as well from the viewer.
Correct, because I can see. I was actually focusing until now on the chat. Chat is also flooded, and this
The-
one is also flooded. Okay. Okay, let me start few. Yeah, what is short? I'm just having a cough because I was just traveling from here to there. Okay, so if we do a covered call, the margin needs for the intraday straddle would be reduced or affected. Okay. Nandanji, I didn't get your question. Would you provide a feedback for that? Nandan, I didn't got you. Okay. Does the margin needed for covered call? Does the margin needed? See, that's a different things. I don't think that will impact that. Okay. Okay. So next one is how about a liquidity if stock, right? You haven't wrote the full question. I think you missed. Okay, so unfortunately, I won't be able to answer that.
Let me help you. I'll skip through the incomplete questions.
Yes, there's a lot of, yeah.
Okay, so there is a question here. Is return calculated on margin used or the price of the underlying?
The price of the underline. Okay, so whenever you find the strike, I said, today I'm going to do the cover call, find out the current price of the underline, get the 1% or half percent. I've given you the trick. Okay, there are a lot of other tricks are there. This is some easy things to implement. So using that, so always I prefer to use the spot price.
Nizam has a question where he's saying, I'm long on futures of Bajaj Finserv and it's going down. How can I hedge or protect it by covered call strategy?
The cold call strategy is to generate the rental income, not to protect your underline going down. So, but yeah, I'll give you one idea. So, but, what you can do, Nizam here, you go and short call something out of the money. Okay, so you're gonna get some premium and just buy a long put because if something is going down, so puts can survive, can help you out. Okay, so you need to buy a put. So now thing is that should you want to pay a money from your own pocket to buy the put, that is one answer. If you're happy, go and do that way. Otherwise, you can fund that put a bit of not the 100%, maybe 50% of that funding can be done by short call. Okay, I hope Nisa that makes sense.
Santosh ji, that was
Yeah.
extremely informative. And I think we should, I am, we've been stretched our time by almost by 30.
50% extra premium. We talk in the data premiums.
But I'm very happy that there's so much of interaction happening between the viewers. There is so much of knowledge share that's happening. So, viewers, in the beginning of the webinars, like I told you, he's one person who has so much of knowledge to share. So, I would suggest that you can tweet to Santosh Ji on Twitter. His handle is at Santosh Pasi, at SANTOSHPASI, and he's quite active as well. So quite confident that he will respond to you too. So if you have any questions, you can definitely tweet to Santoshji on Twitter. So thank you, Santoshji, so much for joining us today. We hope to do more such webinars with you in future. And viewers, have you all had a chance to explore the FYERS app 2.0? The app is available to download on the App Store and the Play Store. Join the waitlist today by visiting fyers.in/invite. Some of the features of App 2.0 includes faster order placement, which is 1/4 of a second to place an order, symbol details with fundamentals and technicals, 360-degree analysis of your stocks to help you with your trading decision. It also has advanced option chain with Greeks, basket orders, create and execute strategies with a single click, and many more features. So download the app by visiting fyers.in/invite. Thank you so much for joining us today. Thank you so much, Santoshji. We hope to do a lot more webinars with you, and we will see you. We'll see you again very soon.
Thank you, Vignesh, and thank you, FYERS team, for providing me this wonderful opportunities. And thank you, participants, to spend time on the weekend. Thank you, everyone. Safe trading. Enjoy weekend. Thank you. Bye.